Hi everyone, welcome to this session of the Tiger Academy, how to choose a high-quality listed company. In the previous lesson, we used the analogy of treasure hunters seeking gold being like an investment strategy. However, what we tend to forget is that most gold is often hidden in ore. To find the gold, we must first mine the ore. In fact, US stock investments are somewhat the same. You'll often find high-quality stocks hidden within certain industries. Choose the right industry and your investments will double with half the effort. In this lesson, I'll take you through the second step of the stock investment strategy, choosing the right industries and identifying high-quality companies within those industries. Before choosing, however, you should first understand what main industries are represented in the US stock market. For the most part, GICS is used to identify industry sectors in the US. GICS is one of the most authoritative methods for classifying US industry sectors. It was launched by MSCI and Standard & Poor's in August 1999 and has since come to be widely recognized as the global industry classification standard. So, what is GICS? Simply speaking, it is the global industry classification standard. You can see that GICS is a model for classifying industries. It gives the global investment community a definition of economic sectors and industries that is relatively comprehensive and globally unified. If you think that's a little abstract, let's expand on it. The GICS classification system has 4 layers comprised of 11 economic sectors, 24 industry groups, 69 industries, and 158 sub-industries. Of course, you don't need to memorize all of the classification criteria. You just need to understand the first level of the 11 economic sectors. Those 11 economic sectors are materials, consumer staples, consumer discretionary, energy, financials, healthcare, industrials, information technology, communication services, utilities, and real estate. So which of these 11 economic sectors is more likely to have gold and the most potential for the future? I've selected 4 industries for you: information technology, energy, healthcare, and consumer staples. Why did I choose these 4 industries? Starting with the information technology industry, I chose it because it includes software and services, technology hardware and equipment, and semiconductors, which are all hard technology industries, attracting the world's top technology crowd and having the highest barriers to entry. Apple, Microsoft, and Google are all well-known global companies in this industry. Secondly, I chose energy because of global warming. In order to save the deteriorating economical environment, major countries are actively advocating development of new energy sectors to change traditional energy consumption habits. Along the way, many new clean energy companies with great prospects for growth will be incubated in this space. Thirdly, in addition to dealing with the global pandemic, an important reason for choosing healthcare is the aging of the global population is accelerating, and so dependence on innovative pharmaceuticals and medical devices is also increasing. Finally, consumer staples is another industry that is likely to produce bull stocks. Demand for consumer staples is relatively stable, and these daily consumables are indispensable regardless of the economic situation. The consumer staples industry is also one of Warren Buffett's favorites because of how stable the demand is. Now we have listed the industries that, in our view, have more potential to have gold companies. But that presents a new problem. Not all the companies within good industries are good companies. How can you accurately find those needles in the haystack? Generally, you need to be able to do 2 things in order to find high-quality companies as investments in the US markets. Number 1, assess the quality of the company. Number 2, evaluate the price of the company's stock. Assess the quality of the company. So how do we assess the quality of a company? The answer is by understanding how to read the company's financial statements. Investment guru Warren Buffett says you have to understand accounting and you have to understand the nuances of accounting. It's the language of business and it's an imperfect language, but unless you're willing to put in the effort to learn accounting, how to read and interpret financial statements, you really shouldn't select stocks yourself. Assessing the quality of a company is like conducting a physical examination of a person. It's important to review all aspects of their health. For a company, this data is mainly derived from 3 charts. The first chart is the income statement, also known as a profit and loss statement. The basic idea is very simple. to let you see whether a company is making or losing money over a period of time. The point of approaching this as a medical exam checklist is that we can directly see the company's profit margin, equity income, development trend, etc. These analyses are essential in determining whether a company has a sustainable competitive advantage. The second chart is called the balance sheet. It mainly illustrates what the company has in the way of assets, how much debt it owes to suppliers or banks, and how much money it takes from shareholders to keep its business running. Through the various items on the balance sheet, such as cash assets, accounts payable, and long-term debt, we can clearly assess the relationship between cash and debt of a company so as to determine whether it has long-term competitive legs. The third chart is called the cash flow statement. This chart allows us to understand where the company's funds come from and how those funds are used. The cash flow statement gives you an idea of how much money is coming in, how much money is going out, and how much money is left on the company's balance sheet. It's the chart that tells the doctor whether the patient is going to live or die. At this point, some investors may ask, what should I do if I don't understand how to read financial statements? The answer is no problem. Just click on the course section in the Tiger Trade app to learn Tiger Financial Reports for beginners. I believe you'll be able to grasp the essentials of reading and analyzing financial reports in a very short time. Now, let's talk about the second ability, evaluating the price of a company's stock. In the US stock market, how can we determine whether a company's share price is reasonable? The answer is to look at the company's valuation. No matter how good a company's financial condition is, its share price is not cheap. You may find yourself buying high and overpaying. This is sometimes called being the greater fool. Therefore, on the premise that you've confirmed the excellent financial condition of a company, finding the right purchase price will greatly increase the probability of future profits. Only by understanding certain valuation indicators can you assess whether the company's share price is reasonable. So you need to learn 3 valuation indicators, namely the price-earnings ratio, the price-to-book ratio, and price to sales. The first valuation index is PE ratio. PE equals share price divided by earnings per share. It's pretty simple to understand. Let's say the price of Tesla stock is $708 per share. Dividing that price by the company's annual earnings per share gives us a ratio approximately of 95 to 1. So we say that the PE of Tesla is 95. As average price divided by earnings ratios vary from one industry to another, you'll need to do a little research to find out what the average is for the industry that your target company is in to know if its PE is high, low, or just right for that type of company. So PE is a sort of rule of thumb that you can use to tell whether a stock is overvalued because its share price is high relative to the company's earnings per share. It can also tell you if the shares are relatively undervalued based on PE. The second valuation indicator is PB ratio. PB equals share price divided by book value per share. To explain this ratio, let's say that after thinking it over, you decide to open a grocery store. You really don't want to build a business from the ground up, so you think it makes more sense to buy an existing store that already has a business. You find one where the owner is willing to sell his store for $800,000 because he's having cash flow problems. After doing your research on the store, you find that in spite of its poor operating profit, the store's tables, chairs, electrical equipment, and various other facilities and equipment are already worth $800,000 by themselves. The PB of the store is only 1, which basically means you can buy the store at cost. My example is meant to illustrate that the PB ratio will tell you how much you're overpaying or underpaying for an asset. Just as with any investment, the closer the price you pay is to the actual value of the asset, the lower the PB, and all other things being equal, the better value the purchase is. The third valuation indicator is the PS ratio. PS equals stock price divided by sales per share, which equals total market value divided by main business income. The greater the business income of a company is, the lower the PS value is. So, a low PS ratio means greater investment value for the company's stock. One point you should keep in mind is that for mature companies, PE and PB are usually combined to assess valuation, while for high-growth enterprises that are not yet profitable, it is more reliable to use PS for the purpose of valuation. For cyclical industries, the market prefers to use PB for valuation. These 3 ratios can be found in the Tiger Trade app by entering the stock code and clicking Analysis. Taking Apple as an example, the current 5-year PE of Apple is in the yellow regular area with the center of the graph. The 5-year PB valuation extends into the pink overvalued area at the top, which indicates a more expensive valuation. When looked at together, the ratios indicate that Apple has maintained a high valuation over the past 5 years, which indicates that the stock is expensive at the current level. So once you learn how to use valuation as a tool, you can tell if a good company has a good price. Now, after having learned the second step of the stock investment strategy, you already know which industries are likely to have potential in the future and how to find good quality companies at their right price. That's all for today's lesson. Let's review. Classification standards for US stocks. Assesses the quality of the company. Evaluate the price of the company's shares. Congratulations! After all of your hard planning, you have learned how to increase the chance to find gold. But the investment isn't over. In the next lesson, I'll show you how to bargain with the buyers and how to sell your gold at a higher price. I'll catch you next time.